Okay. I think we could get started slowly. Welcome, everyone. So my name is Eva Ortega from Bank of Spain. I will be chairing this session on the financial conditions and the policy responses during the COVID pandemic. I would like to thank the three paper presenters and the three discussants for agreeing to be part of this session. And well, I think I had contacted all of you individually, but just a reminder that paper presentations would last 20 minutes, then discussants will have 10 minutes, so that we all have 10 minutes after each paper for questions from the audience or among ourselves. And yeah, with no much further ado, I think we can move to the first paper that will be presented by Jim Costain from Banco de España. So Jim, you have 20 minutes.
Yes, and there we go. There are the slides. Okay. So by the way, it is 20 minutes from now, right? Because we're already running 3 minutes late. Those extra 3 minutes are going to be valuable. Okay, so this is joint work with my colleagues Galo, Nuño, and Carlos Tomas at the Bank of Spain. You may notice that the title has changed. We're being a little bit more ambitious. It's not just a policy exercise. We're really trying to offer a general model of the term structure that's applicable to Europe. Okay, I should emphasize the disclaimer. These are policy relevant issues, and it's important to say that what we're presenting here is our personal view. Okay, so as the pandemic hit, a crucial policy concern here in Europe was fragmentation. So we saw that the pandemic was having a highly asymmetric impact on different countries in the Eurozone. In particular, you can see here, I assume you can see my cursor, that Italian yields were rising in February at the same time that German yields were really crashing, okay? And then likewise, as yields really spiked in Italy and also in other peripheral countries, while in France and Germany, they eventually followed the same trend, but with much less variance. Okay, so we want a model that's going to make it possible to analyze the impact of the pandemic, and in particular, the impact of the PEP purchase program. And we find that it's crucial to take into account the fact that the periphery in a monetary union has a possible risk of default. Okay, so there is a lot of work on modeling interest rates, and moreover, I want to emphasize it's not just the level of the 10-year rate. There's a really striking stylized fact about the way that the yield curve moved at the onset of the pandemic, and then also in response to PEP. Okay, so this is the change in the yield curves from February to March, as it was becoming clear that the pandemic was a real threat to the European economy. And so you see the Italian yields basically shifted up in parallel. This is also showing the Spanish yields down here. The movement was not as large. It was not quite as parallel, but it was a very similar movement. On the other hand, what happened in Germany was very different. It fell and got steeper. The term premium rose at the same time. Okay, and then upon the announcement of PEP, we had movements that were almost the mirror image. They weren't quite as large as the pandemic movements themselves, but Italian yields shifted down in a parallel way. Spanish yields shifted down in a mostly parallel way. And then the German yields got flatter, okay? So we want a full term structure model to try to analyze these shocks, because in fact we think that these movements of the term structure are really diagnostic about what was going on at that time. And so there have been a lot of there have been a lot of sort of reduced form analyses of the term structure in the context of a monetary union, but we actually want to try to build a microfounded model. Okay, so we're going to be working within the class of affine term structure models, which are models that use a simple preference calibration and absence of arbitrage in order to model the yield curve. Okay, they take as given the short rate in the economy, but then derive the rest of the yield curve through absence of arbitrage. And this is often done in a sort of reduced form way, putting in some ad hoc macro factors and seeing what they do empirically. But Vallanos and Vila showed us that you can actually use this as a structural model. In particular, they wrote down a model in which there was an underlying preference specification driving this arbitrage problem, and on the other hand, they structurally modeled the impact of asset purchases, or basically changes in the net bond position in the economy, which is obviously something you can use to analyze programs like the PEP. Okay, so like I was saying, quite a lot of work has been done in the Eurosystem to use affine term structure models in order to try to see what's going on recently. But it has mostly been done in a reduced form way. And what we actually want to do is generalize the Vallanos-Vila model in order to allow for default risk, because default risk is what we're going to need to explain what's going on in the Eurozone. Okay, and default risk is a different kind of risk. The standard risk that shows up in the affine term structure models is a Gaussian risk to the prices. And much of the literature has looked at US data, assuming that US bonds are default free. So they didn't have to worry about this. But if you actually think about default, it's a risk of a one-time event that does a haircut on your bonds. And so that's not a Gaussian risk. And you have to, it shows up differently in the model. Okay, so we try to do that right. And at the same time, we also want to think about what is the impact of fiscal policy on default risk. And so we wrote down a relatively simple but pretty standard model of rollover crises that gives us a structural functional form for how the default probability should behave when we change fiscal policy. Okay, so we're going to be able to play with this model in order to look at the impact of PEP and then think about counterfactual scenarios. What kind of counterfactual scenarios do we want? Well, this is actually the question that originally motivated us. There was a whole lot of talk about the fact that the PEP is flexible. Previous asset purchase programs of the ECB had been done with a fixed rate of purchases over time, and they also fixed the distribution of the asset purchases across asset classes, and more importantly, across different countries, fixing each one to capital key. Okay, but the PEP was explicitly announced as being flexible. It would be spent where it was needed, when it was needed. And so what we see was actually done is that there was substantial front loading of the purchases. A whole bunch of it was done right March through June. And it was also allocated flexibly across countries. Now, you might think it was paid out to all of the peripheral countries, but actually what happened is that there was a substantial increase in purchases to Italy relative to its capital key. And that was more or less compensated by a decrease in purchases of French bonds, okay? So we're interested in knowing theoretically, using a model, what's the value of having that flexibility, okay? So we get some very nice findings out of this model. First of all, by writing down the structural model, we get an analytical decomposition of the yield curve. And so you can break it into some standard terms that are not related to default, a term that represents the expectations hypothesis, also a term premium. But then you can also separate the part that is actual default, that's actually related to default, okay? And so we can use the model to measure what is the expected loss due to default in the model, okay? And then on the other hand, one thing is what's the expected loss, and then the other is, given the degree of risk aversion in the model, which is nailed down by the structure of the model, when you calibrate it, we can ask how big is the risk premium on that default risk. Okay, so that turns out to be by far the most important part of the European yield curves. And so that brings us to a very strong policy conclusion, which is that the transmission channel of asset purchases in the euro area is different from the transmission channel that's been talked about in the United States. And it's also different from what a lot of ECB papers that didn't use this structural model have concluded. Okay, it's not duration extraction. By duration extraction, we mean taking some long bonds out of the market, and because arbitrageurs don't need to hold so many of those bonds, the risk premium falls. Okay, we actually find it's default risk extraction. It's taking default risk out of the market, and that has two effects. On the one hand, it actually lowers the probability of default, but the more important thing is that it makes the market more willing to hold that default risk, and so it has a huge decrease in the credit risk premium. All right. Given that, it's clear that policy flexibility boosts the impact of PEP. In other words, it's more valuable to spend money on peripheral bonds where you can get rid of that default premium than it is to spend it on core bonds. So reallocating, if you take the same quantity of purchases, but reallocate them towards the periphery, that causes a net fall in European interest rates, an average fall in European interest rates. And at the same time, it does almost nothing to the core rates. Okay. And then finally, we looked at the different dimensions of flexibility. And we find that flexibility over time and flexibility across jurisdictions, they're not substitutes. They are actually slightly reinforcing each other in our simulations. Okay. So the model that we're doing is really, truly just a generalization of Vajanos-Vila, but we take it and we do it to multiple countries. We need two in order to illustrate the mechanisms. So there's one called core, there's one called periphery. Okay, core is indicated by an asterisk. So bond prices at time t of maturity tau are going to be pt of tau. Y indicates the yields. Then the gross bond supply, this is going to be the total amount emitted by the government, ft of tau. That's the amount of peripheral bonds outstanding of maturity tau at time t. And then the central bank can choose to hold some part of that. So that's going to be FCB T of tau, all right? Okay, now here is how we model default. This is basically taking a rollover model similar to Kolen-Kehoe or similar to Corsetti and Dodola. And so it's saying every so often, the market might panic and stop buying some class of debt. Now, if that happens, you as the victim of that rollover crisis are going to have to pay for your current expenditures out of your pocket. In other words, you're going to have to raise some emergency taxes in order to pay if you don't want to default. Okay, so what's going to enter into the costs of defaulting, no, the cost of repaying is going to be the current deficit that you need to finance, and then the current amount of bonds that you have to repay to private investors, because the part that you pay to the central bank will come back to you as seigniorage revenue under any reasonable and realistic model of seigniorage. Okay, so this is the costs that you're going to have to pay if you decide to repay, and then on the other hand, we assume that there's a stochastic cost of default governed by some CDF, and so what that's going to do is, to a linear approximation, or assuming a uniform distribution of default costs, it's going to give us this functional form. Okay, so basically the default probability is going to vary over time depending on how big the deficit is and depending on the net amount of redemptions that the country has to pay to the private sector. All right, so we're going to be able to identify this slope by noting how much these expected redemptions change under the change in fiscal policy implied by PEP, and so that lets us calibrate the whole model. Okay, and then we can do policy experiments using that, fixing that theta. All right. Okay, so the model is going to be driven by a single shock process. It's the risk-free rate, which we equate to the German short rate. And we are going to conjecture that the bond price has an affine functional form. Okay, that conjecture is not necessarily right, but we're going to set the model up in a way such that this is a valid solution. Okay, so this is the objective function of the Vianos and Vila model. Arbitrageurs have mean variance utility over the increase in wealth. Okay, so they like getting a higher expected growth in their wealth, but they dislike risk. And the change in wealth simply consists of these two terms. These terms are the income that you would get from putting your money into a bank, and then the bank, by competition, will pay you the reserve rate. So that's just safe income that you get by putting your money in the bank. And then these are the capital gains on your bond portfolio. Okay, so you have to use Ito's lemma to work through what are the capital gains. And that gives us this expression for the expected bond return. This is standard because this comes from Vianos and Vila. Okay, so if you plug all of that stuff into the arbitrageurs problem, then there are four terms. Okay, the first term is the expected capital gains on your portfolio, net of what you've got in the bank. The second term is a risk premium. Okay, but this is the standard kind of risk premium that you have in a default-free model. This is just the risk of variation in the prices driven by the underlying factor, which is the short rate. Okay, now the next two terms are related to default. Okay, and so this is the actual expected loss. Okay, with probability phi t, the government is going to default, and therefore the arbitrageurs are going to lose part of their wealth, and we assume that the haircut is fraction delta of the value of the bonds. Okay, so this is the actual expected cost of default, but then there's a risk premium on top of that, just like there is on price risk. Okay, and the nice thing about this structural model is that by calibrating the model, you tie down the degree of risk aversion. That's gamma here. So that same amount of risk aversion is going to apply to default risk that applies to price risk. Okay, all right, so you can work through the first order conditions, and let me just take this through until we get to the term structure decomposition. So this is basically a decomposition of the first order condition, and it breaks the yield that's required for an arbitrageur into four terms. Okay, there is a term which is simply the expectations hypothesis. This is that your yield has to compensate expected future short rates. Second, there's a term premium. This is the compensation that risk-averse investors need in order to hold an asset whose price fluctuates over time. Okay, and then this is the expected loss due to default, but then there's also this risk premium term. Okay, all right. So what we can do is we can now calibrate this model to German and Italian bonds. Those are going to be core and periphery in our model. And so basically there are two parameters that you can tie down immediately. The German market ties down the degree of risk aversion because the German term premium depends on the degree of risk aversion. And so in order to match the steady state German yield curve, that nails down the degree of risk aversion in the market. Okay, now Italian yields on average are higher than German yields. And so that gives us our second free parameter, which is the steady state probability of default. Okay, and then if you look here in the graph, there are two pieces here. There's this tiny piece right there, which is 4 basis points per year. That is the expected loss due to default. All of this stuff is the risk premium. Because the model ties down how risk-averse agents are, we know how big is the risk aversion compared with the amount of risk. So it turns out there's not much risk on Italian bonds. Okay? So now what we can do is take that model and shock it by changing fiscal and monetary policy, and that's going to give us the impact of PEP. Okay? So basically there's this one free parameter which is the slope of the response of the probability of default to fiscal policy. Okay, and so
you have a couple of minutes left. Sorry, you have a couple of minutes.
Okay,
a couple of minutes.
yes. No, I understand. So this is one of the two main results slides. All right. So with that one free parameter, we fit the shift in Italian yields when PEP was announced. And notice almost all of this goes through a decrease in the credit risk premium. Okay, there is a tiny decrease in the expected loss due to default, because in fact the default probability decreases slightly when the ECB purchases part of this debt, but this is only about one basis point. Okay, so the vast majority is just that default is less likely and there are less defaultable assets in private hands, and that is why PEP has a large impact on the market. Okay, so those are highly persistent. And then what I want to do is, as a last result slide, is just show you what is the value of the flexibility of PEP. Okay, so PEP front-loaded the assets, and it also gave more. It made more purchases of Italy than would have been implied by the capital key. And so this is comparing the impulse response to PEP with the impulse response to a different program that would have been structured like the APP, namely a constant pace of purchases and capital shares. Okay, so basically this is saying that there was almost an extra 15 basis points of impact due to the flexibility of PEP rather than to as compared with an alternative program like APP. Okay, reinvestment still has there's a lot of powder left in that keg if we need to continue stimulating the economy. And so these are the basic conclusions. Okay, I think I've made these clear, but I'll just leave these up until my discussant begins.
Thank you, Jim. So it's the turn for Walker Ray from LSE to conduct the discussion of this paper. Thank you, Walker. So you have
so I will
10 minutes.
Click on stop share.
Okay, thanks. Can everybody see my slides and hear me?
Yeah, we do.
Okay, perfect. Great. So thank you so much for the organizers for asking me to discuss this super interesting paper. Very relevant for, I think, a lot of the policies that are going on, and also I think very informative. I learned a lot thinking about the model that the authors have written down here in this paper. So just quickly to summarize a little bit what Jim was already telling us, the big picture motivation for this paper, the authors are interested in kind of two things. First, what are the determinants of the yield curve in a monetary union? In particular, a monetary union in which some of the countries are issuing sovereign default-free bonds, but other countries, the periphery, are potentially issuing bonds that they may default on. So that's the first thing that's a little bit new about this paper. And then they're going to ask, from a policy perspective, how does unconventional monetary policy, large-scale asset purchases, in particular on the part of the ECB, how does unconventional monetary policy affect yield curves in the core and the periphery? In particular, how do large-scale asset purchases affect term premia, and how do they affect credit risk premia? So to answer this question, we have, it's certainly not that there's no models out there that can answer this question, but as Jim was saying, a lot of them are a little bit more kind of reduced form. But the reason that we don't have a perfect model for answering this question is we kind of need two things. One, we need a model in which there is actually priced risk, both term premium risk and credit risk, which means we also need to have a model in which these countries may default. But also, and very key here, is we need a model in which shifts in quantities are going to matter for the pricing of bonds. So in terms of thinking about, and of course, that's absolutely crucial for thinking about large scale asset purchases. Otherwise, what are we doing? There's nothing we can do. When thinking about large scale asset purchases on the part of, say, the US Fed or other ECB programs, it's very natural to think about, say US Treasury debt as being risk-free. And that's been kind of the realm of these kind of preferred habitat type of models that were started, I think, by Vianos and Vila, really kind of resurrecting this literature. But what's been missing from this research agenda so far is actually modeling default. So just briefly, the reason these preferred habitat models are so useful here is because it kind of specifies that there are a set of investors who have idiosyncratic preferences for bonds of specific maturities. And so the shifts in their demand, the shifts in the amount of bonds that they hold, in principle at least, can lead to changes in yields, because in equilibrium, other types of investors who are risk averse, but who are trying to trade away any arbitrage opportunities, shifts in their allocations of bonds will therefore shift their exposure to risk. And in equilibrium, to the extent that they're risk averse, that can lead to changes in prices. So that's been kind of a useful modeling framework for thinking about large scale asset purchases, say, conducted by the Fed. And that's been a lot of the stuff actually that I've been working on recently. There's been many papers here that have looked at using this preferred habitat type of lens to think about government debt management. Thinking also about multi-country extensions, where we're thinking about, say, exchange rate risk as well, or stuff that I've worked on, say, thinking about the type of what this means for the transmission of monetary policy in a more macroeconomic setting. But all of these papers are assuming that the bonds that are issued by the government are default risk-free. And of course, that's not going to cut it when it comes to thinking about the Eurozone, when we actually want to think about how ECB policies may be affecting the periphery. So for that, that's what kind of the main kind of theoretical contribution that this paper sets out to do and accomplishes, and then uses this kind of quantitative calibrated version of the model to study the latest large-scale asset purchase that the ECB undertook, looking at German and Italian yields. And so, as I said, and as Jim explained, this framework allows for the periphery to endogenously default while still maintaining a lot of tractability that you get in these types of preferred habitat models, and can derive a nice decomposition of the yield curve into expectation components and risk compensation components. And moreover, decomposing that risk compensation into term premia, the usual term premia we see in these models, and then the new one, which is this credit risk premium. And so the mechanism here is basically the ECB, when it removes sovereign bonds from the balance sheet of private investors, this PEP program works basically through two possible channels. One, it might reduce the probability of default, since these bonds are now kind of part of this consolidated government balance sheet. But also, importantly, and what's new in this model is that it also is going to therefore reduce the risk compensation that private investors require to hold these bonds. Basically, because the ECB has now transferred these risky bonds off of the balance sheet of private investors and onto the ECB's balance sheet. Because these private investors are now less exposed to default risk, in equilibrium, they're going to require less compensation to hold that risk, and that's going to push down yields. And then their quantitative results, as Jim just described, they find that the reductions that are due to term premia or the actual probability of default are quite small, and this largest reduction is coming from credit risk, changes in the credit risk premium. And I think this is kind of one of the main figures in the paper. Once you feed in PEP into this model, you see that German yields fall very modestly, just a few basis points, which is coming from the reduction in term premia that's required by investors. The reduction in term premia for Italian yields is similarly quite small. The reduction in the default probability is very small as well. But as we see in the data, Italian yields do in fact fall by quite a bit, and that's all because of the reduction in the credit risk premium. So I'm happy to see that the latest version of the paper that Jim sent me has a new title, and I think is really focusing a lot on the model, because I find this model super interesting. It's a really nice extension of the preferred habitat modeling framework. So for the rest of my discussion, I just want to talk a little bit more about the model and maybe push the authors to actually kind of explore their model even in more detail in the next version of the paper. So like in Vianos and Vila, there's going to be bonds of different maturity that are issued with some prices, where star here denotes core, with no star denotes the periphery. And we're going to have this usual exogenous short rate process, which I kind of think of as conventional monetary policy, where there are shocks to the short rate that mean revert according to some mean reversion parameter kappa. The new thing here is that the periphery can default during these rollover crises, whereas the core does not have any default risk. And as is the case in these preferred habitat models, there's going to be two sets of kind of players, two additional sets of players in the bond markets. There's going to be these, what we call preferred habitat investors, who are going to be maturity and country specific and are responding elastically to changes in price. They're specific, they kind of focus either on a specific maturity and a specific country. But so you can kind of think of these as like price elastic noise traders. And on the other side of the market are going to be these arbitragers who allocate their wealth across all bonds, smooth out the term structure, but they are risk averse. So they care not only about the expected change in their wealth, but also the volatility. And I'm not going to spend too much time here because Jim already described this, but basically if you conjecture and then kind of guess and verify that this model does in fact have this nice log-affine term structure, you can summarize the arbitrager's portfolio allocation problem as basically involving kind of four different effects. One is looking at the expected excess returns on bonds. Two is going to be the expected loss in terms of default. And this would come up, kind of in any model, including a model in which pricing is all done by risk neutral investors. But these arbitrages are in fast risk averse. And so you also get a term that's related to compensation for price risk, return premia, and then some type of compensation that's going to come for the volatility that comes from default risk. And so the last thing that I want to talk about here, and then try to keep myself on time, these are just a few, so like I said, I love this model and I think it's an incredibly useful extension for the preferred habitat framework. And I really think the authors should push a lot even more kind of on exploring, not that to say that their policy experiment is not super interesting, but I think the model really, you can kind of push on it even more and explore it a little bit. So this slide here, apologies for a lot of the math here. This is kind of my own attempt at doing a little bit of analysis of their model.
I don't know if it's me, but Walker, I stopped hearing you.
Yeah, I think he's
I'm
frozen.
sorry, I just lost it too. And
yeah,
this was a really interesting
seeing,
part.
He might, these things, he might resolve itself. Hi, Walker, are you back?
Yeah. Oh, I'm sorry. Was I cutting out?
We lost you for about 30 seconds.
Yeah.
Oh, I'm sorry. Okay. I was just talking to myself for 30 seconds. So you guys can hear me now?
Yes.
Yeah.
Okay. So the last thing that I want to say here is basically just a little bit of how thinking about the transmission of monetary policy in this model, just a few of my own calculations here. So apologize for kind of bad notation and any possible mistakes here. Basically, although the model is complicated, we can kind of summarize how shocks to the short rate transmit to the core and the periphery yield curve by two relatively simple exponential expressions here. This M term and the zeta term are quite complicated. We can just kind of ignore those for a second. Basically, what is this telling us though? In response to a monetary policy shock, if we look at what happens to the short-term interest rate and expectation after a unit shock to the short rate, tau periods from now, well, we just have this very simple kind of stochastic process governing the short rate. So tau periods from now and expectation, the short rate is going to will have gone up by the exponential of negative kappa times tau. That's going to be greater than this expression here that depends on this M parameter, which in fact is going to be how much the instantaneous forward rate in the core responds to that monetary policy shock. So this F term here, and sorry, this is probably inconsistent with the paper, this is the response of the instantaneous tau maturity forward rate. Under the expectations hypothesis, the forward rate, the tau maturity forward rate should be responding exactly the same as the expected short rate tau periods from now. In this model, like in the Vianos-Vila model, there's going to be this underreaction. Forward rates are going to respond less than they would to conventional monetary policy. And that degree of underreaction is going to be governed by this endogenous parameter M, which we can think of as basically the risk neutral dynamics of the short rate relative to the physical dynamics denoted by this kappa term. Actually, and I think this is right actually, but the periphery yield curve, we're going to have actually an overreaction for short-term yields, underreaction for longer-term yields. And we're going to get also that in response to this monetary policy shock, the spread between core and periphery is going to increase as well, where the degree of that increase is going to be governed by basically the default parameters of the model. And under certain assumptions, I think you can say that basically this kind of, let's say, deviations from the risk neutral dynamics are going to be increasing in risk aversion, increasing in the volatility of monetary policy, and increasing in the elasticity of the habitat investors again, this is all relatively similar to Envianos and Vila, this degree of underreaction is also going to be increasing in the default parameters themselves. I think this is super interesting. I think what's going on here is basically, so suppose, the ECB cuts its policy rate. All else equal, arbitrageurs are now going to want to borrow at the short rate and invest in longer term bonds, basically do that kind of term structure carry trade. However, these elastic and habitat investors also start responding. That's going to lead arbitrageurs to be more exposed to both core term premium risk and periphery default risk. And the more the higher is that default risk, the less they're going to want to do that carry trade, which is going to lead to this increased underreaction in both the core and the periphery. So that's just a few things that I think this model can deliver, which I'd like to maybe see the authors explore a little bit more. Also explore that kind of quantitatively, because after talking with Jim a bit more, it seems that quantitatively some of these channels I'm talking about might be quite small. But I think it suggests, again, I think this model is super interesting and suggests kind of new avenues for exploration, both analytically and quantitatively. So I know I'm probably a little bit over time here, but let me just wrap up and say, I think this is an extremely useful extension of this kind of modern preferred habitat framework. I've been waiting a while to see kind of endogenous default added into this. Yeah, let me just end there and open it up for discussion.
Thank you, Walker. I'd suggest, since we have just not even 5 minutes left, I suggest to gather questions from either other panelists or from the audience so that Jim can have all the feedback, and then I'll pass you the floor, Jim. Is there any, I don't know, maybe you can use the chat or raise your hand or just open the microphone? No? Okay, so I give you the floor, Jim, and while we wait maybe for an extra question.
I have a very brief question for Walker. You were just talking about an increase in the conventional short rate, leading to an increase in spreads over time. Is that what you were? Okay.
Yes,
okay.
I believe that's what comes out of your model. Although you should definitely double check me.
Yes. No. Working through that math is extremely helpful for us because, to be honest, I mean, we analytically went through the decomposition, but in terms of the dynamics, we've just been looking at this stuff numerically, and the model is very tractable to work with numerically, but it's helpful to take a closer look at the dynamics. So, in response to one of your questions, you were asking about quantitative exploration. So I've done a little bit more robustness analysis, in particular with respect to the slope of the preferred habitat response. And basically this morning I was just multiplying it by 4, dividing it by 4. You end up slightly adjusting the risk aversion parameters that you calibrate in that case. But essentially there are very small quantitative changes, and the ultimate policy exercises are very similar. I mean, the nice thing that we've discovered about this model is the way that you can essentially parameterize it in this step-by-step way. First, you get the risk aversion from Germany, then you get the steady state default probability, and then PEP gives you the impact of the shock. And that's been very robust. We've been making minor changes to the calibration for a long time, and basically we keep getting the same results.
Eva, can I ask a question?
Go ahead.
So it's great paper, James, and very nice discussion, Walker. So I have a question. So in terms of the empirical properties of these things, so the way the monetary policy spills over to credit risk premia actually differs a lot across advanced economies and emerging markets. I documented this in detail in my 2019 Jackson Hole paper. And actually one interesting thing there is the difference between ECB policy and US monetary policy. Of course, this is not that relevant for you because clearly you are only going to focus on these countries in a monetary union. So the only policy relevant ECB, and they don't have their own monetary policy to respond. But I think it would still be interesting within your setup to see these kind of southern countries, who are more like emerging markets, and then kind of northern countries who are less like. I mean, I think it's actually even kind of a better setup than my Jackson Hole paper, because everybody has one monetary policy. Because in my paper, I document this short rate disconnect where credit risk premium really, works through there because of this short rate disconnect phenomenon where countries' own monetary policy cannot do anything about it. So here you have that exogenously set. So, but it would be very nice, I think, to kind of look at this in terms of your calibration differences between a southern country and northern country, where there's going to be a real depreciation. I mean, even if it's the same monetary policy, the real variables are going to react. So I think that would be interesting.
Yeah, no, I mean, certainly some of the analytical structure we put together could be applied to developing countries as opposed to just the periphery of the Eurozone. Maybe that is partly an agenda for Walker now, since I know he's been looking at exchange rates, whereas we're just staying in this context where the exchange rate by definition is fixed. But yeah. So by the way, the crucial thing that we did in order to get tractability here is that basically we're looking at MIT shocks. The fact that you can maintain the affine functional form is precisely because we treat the probability of default as a deterministic sequence. So we think for looking at the impact of the pandemic or looking at the impact of the PEP, just saying, okay, there's this one-time change in everybody's expectations, and what are the dynamics that implies? That's a case where we can make that kind of assumption in a plausible way. But if the probability of default itself is stochastic, then the affine functional form fails, and you start to get some nonlinear terms in there. We have some conjectures about how to deal with that, but we have not done it yet. So yeah, for the time being, it's a limitation of what we can do.
I mean, that's super interesting. But the thing is, like, in the data, credit risk premium is going to be super important. I mean, I document extensively. And in fact, people's first sense is, term premium or exchange rate is more important. No, I mean, credit risk premium, exactly as you model, is the most important thing for monetary policy spillovers. It is more important for the US policy than ECB policy. But with ECB policy, it's also very, very important in terms of like kind of global monetary policy spillovers. And I work with monetary policy shocks, like the surprise shocks, both for ECB and US. And credit risk premium is like super important. I think this point has been missed a lot before in the data, and now, thanks to you, I think it was also not in the models. So I think
the credit risk premium you're talking about is within U.S. corporate bonds, or you're talking about southern countries?
Outside U.S., both corporate and country, both corporate and country. Yeah. So exactly that's what Volker was talking about in the last slide. So it works through both corporates and countries, actually, but all other countries. So when I did this exercise, in the Jackson Hole paper, it is like outside Europe, outside US type of idea. Yeah, and the differences. Yep.
Okay.
I think we should stop here. Sorry for interrupting, and move to the next paper. So Balint Horvath is going to present from University of Bristol, and then Camelia Minoiu is going to make the discussion. So if you can stick to the 20-minute presentation, 10-minute discussion, then we'll have time for discussion afterwards. Thanks.
Thank you very much. And thank you to the organizers for including this paper on the program. So this is joint work with Asli, Demirgüç-Kunt from the World Bank, and Huizinga from Tilburg University. And you can hear me, I hope.
Yes, we do.
So in this paper, we study the effects of corporate QE that was implemented in Europe in response to the pandemic crisis. So the European Central Bank announced the pandemic emergency purchase program with an initial scale of 750 billion euros in the evening of March 18th. So the eligible instruments included investment-grade corporate bonds issued by non-bank companies incorporated in Euro area, and the Bank of England announced a similar program the day after with a size of 200 billion pounds. So importantly, financial markets could react to both announcements on the 19th of March. And what we do in this paper is we look at the announcement effects or the effects on valuations of equity and debt in Europe in response to the announcement. And we look at equity, so share price changes and CDS spread reactions for that purpose. And we think that this is an interesting question because by looking at the relative changes in the values of equity and debt instruments, we can learn about how effectively this policy reduced the potential costs associated with financial distress. We also look at whether firms that were particularly heavily exposed to the pandemic were more or less affected by QE, and we'll also see how national fiscal policy responses interacted with QE. And for that purpose, it is especially useful that we're looking at European data because we can have a cross-country sample. So prior literature, obviously there are lots of papers that relate to our study. A lot of papers looked at conventional monetary policy effects on stock prices. Typically these papers find that stock prices increase following a reduction in the policy rate. There are also papers that look at QE, how QE affects bond markets, and typically they find a reduction in yields. There are also papers on the effect, the financial market reactions to the US policy response to the pandemic. So the Fed implemented similar asset purchase programs as the ECB. And there's also a paper looking at the effects of the large fiscal stimulus that was announced on the 24th of March by Fallenbach and co-authors. So in order to motivate our paper, we have a very simple model. It's a two-period model where a firm can borrow in the first period to finance working capital at an interest rate that is affected by monetary policy. So this firm is financed by equity, pre-existing debt, and debt incurred in the first period. And this debt is basically risk-free because period 2 production by the firm is enough to repay these short-term lenders in every state of the world. And we also assume that this borrowing is senior to pre-existing debt. As I mentioned, the period 2 output is random and is distributed on this interval between Y lower bar and Y upper bar. We assume that investors are equity, we assume that investors in equity and debt are risk neutral, and under this assumption we can derive very straightforward formulas for equity value and debt value, which I'm not going to go in detail here. What we do next is we show that reduction in the interest rate leads to an increase in the value of equity and debt that is proportional to the change in the interest rate, so the monetary policy rate, and so that's the first channel. So equity and debt value increases because there is a higher discount factor, which increases value. And there's also a second channel where lower interest rate reduces the cost of refinancing or financing working capital. And so this is proportional to the amount of borrowing that the firm requires. So it's proportional to W that you can see here. And importantly, it's also proportional to the probability of failure of the firm. In case of equity holders, a higher probability of default leads to a relatively smaller increase in the value of equity. And for that, it's the opposite. For higher probability of default, the value of that increases relatively more, following a decrease in monetary policy rates. And the reason for that is that the additional value that is created by the lower refinancing cost materializes for shareholders in non-bankruptcy states, and debt holders enjoy the additional gains in bankruptcy states. And what we do in our papers, we basically look at how equity and debt value changed differentially for different kinds of firms, depending on basically on their borrowing requirements and the survival probability that they have. So we can also calculate in our model the relative gain to shareholders relative to the total gain created by QE, and this gain declines with the firm's overall debt service burden for the same reason that I explained a moment ago. So these regressions illustrate that there is a debt overhang effect of monetary policy in the sense that gains created by QE are distributed differentially between equity holders and debt holders, depending on their probability of survival and refinancing needs. So in the paper, we look at financial effects of this debt overhang story, but we could extend the model very easily to capture real effects as well by adding a simple project that the company could undertake. And under certain circumstances, shareholders decide not to implement this additional project, even though it's a negative MPV project. So we in the empirical work, we basically have some proxies for firms' probability of failure, and we'll link that to valuation changes. About the data, we have a sample of European firms that are publicly traded, and we excluded financial firms, utilities, not-for-profits, and governmental firms. The data comes from Thomson Reuters Refinitiv, and the valuation variables that we use are the following. We look at excess returns on the 19th of March, calculated using simple single-factor asset pricing model. We also look at changes in CDS premiums, and in order to be able to compare changes in shareholder and debt holder values, we also calculated the total change in the market value of equities relative to book assets, the book value of assets, and the total change in the market value of debt relative to the book value of assets, and the fraction of the shareholder gain relative to the total change in assets, the market value of assets. So calculating the market value of equity is straightforward. Calculating the market value of debt is a bit more involved. We follow Veronesi and Zingales, who calculate the change in a firm's debt using CDS spread data. So we can calculate the cost of insuring the firm's debt against default by basically multiplying CDS spreads, the total amount of outstanding debt the firm has, the probability of not defaulting up to year T, and the discount factor. And by calculating the insurance cost before and after the announcement date, we can estimate the change in the insurance cost, and basically that proxies for the changes, the change in the market value of a firm. The independent variables that we look at are the following. So we have measures to capture the direct effect of QE. So we look at firms' credit ratings as investment grade rated firms were eligible, or their bonds were eligible. And we also look at their reliance on bond financing. Then, importantly, we look at other firm characteristics that proxy for credit constraints and debt overhang. So we'll use leverage and the equity book to market ratio as proxies for these constraints and the survival probability. Finally, we look at various measures of exposure to the pandemic and the strength of fiscal policy responses in various countries, European countries. The methodology is straightforward. We estimate OLS regressions where we include country fixed effects and also cluster standard errors at the country level. Right, so let me jump straight to the first main regression table. So we find that announcement date returns were positive on average to equity holders, and especially so if they had an investment grade rating, as you can see here. And importantly, we see that the returns were relatively smaller if for firms that had higher book to market ratios, and that's consistent with our model, in that these firms are likely more vulnerable, and so we would expect a relatively smaller share of the gains going to equity holders. And that's confirmed by the CDS spread regression. So we find that CDS spreads declined on the day following the announcement of QE, and these declines in CDS spreads were relatively large for firms that had high leverage ratios and high book to market ratios. So let me just go back for 1 second. We also find that excess stock returns were relatively large for firms that relied on bond financing and that had an investment grade rating. Again, this is consistent with benefits due to smaller refinancing costs of these bonds. So in order to be able to compare these valuation gains and avoid having to compare apples and oranges, we calculated, again, the total changes in the market values of equity and debt. In column 1, you see regression where the left-hand side variable is the total change in the market value of equity. In column 2, we have the total change in the market value of debt relative to the book value of assets. And in both cases, we see that the gains were relatively large for investment grade firms, that very much expected. And the gains to shareholders declined with leverage, while the gains to debt holders increase with leverage. And the same is true for the book to market variable. And we get similar results when we calculate the share of the total gains that accrue to equity holders. So relatively more of the total gain accrued to debt holders for firms that that were more levered and for firms that had higher book to market ratios. So overall, these results suggest that there is a debt overhang effect of monetary policy, in the sense that more of the gains accrue to debt holders for firms that were more exposed to financial distress. And this is that suggests that monetary policy was effective in that sense, that it worked the way we would want, we wouldn't want necessarily to create large gains to shareholders. So next, we look at the effects of QE on affected firms. And we could think about the effects in three different ways. There are three possible outcomes that we could imagine. First, we could argue that highly affected firms became more vulnerable. Their probability of bankruptcy might have increased, well, it probably increased. And as a result, we could expect that that overhang story applies as I just explained, and we would expect a relatively low return to shareholders and relatively high return to bondholders. Alternatively, it could be that these firms are so badly affected that they will, the market expects that they won't be able to implement a lot of profitable projects. They either because they won't have such investment opportunities or because of borrowing constraints. And so we could expect relatively low equity returns and low bond returns, as QE will not will create smaller gains for these firms. And finally, it could be that exactly because these firms lose revenues, they might have to borrow more, and perhaps QE affects them relatively more, in which case we would expect high equity and bond returns. So we have two measures to capture exposure to the pandemic. First, we have a dummy variable that indicates that the industry of the firm belongs to one of these industries that were identified by the OECD as particularly exposed to the pandemic. And there is another one, and there's another variable we use, the turnover decline, which is the change in turnover at the two-digit NACE industry level in the first quarter of 2020 relative to the turnover in the first quarter of 2019 multiplied by -1. So higher value means a bigger decline. And we find that firms benefited relatively less from QE if they were more exposed to the pandemic, right? As evidenced by these negative significant coefficients in the equity, the excess return and equity value change regressions, and by higher CDS spreads. And the same is true for investment grade firms. They benefited relatively less. Again, we get similar results when we look at turnover decline. So these results suggest that monetary policy was a rather blunt tool given its untargeted nature. It did not help industries that were particularly affected by the pandemic. And so finally, we look at the interaction between QE and fiscal variables. So we expect that firms that are located in countries with strong fiscal responses had relatively lower probability of failure and might need a relatively larger amount of future borrowing. So we would expect that these firms benefited relatively more from QE. And to capture this, we have the total amount of fiscal spending announced up to March 17th in a given country relative to the country's GDP. And we also look at the sovereign CDS spread of a country at the end of the year of 2019. What we find is that firms that were located in countries with stronger fiscal policy response actually benefited more from QE. We have these positive and significant coefficients across the board. And we get similar results when we use sovereign CDS spread as an indicator of how much QE benefited vulnerable countries and their ability to provide fiscal stimulus in the future. So to wrap up, we provide evidence that there is a debt overhang effect of monetary policy, in that it benefits debt holders relatively more if a firm is relatively more likely to face financial distress. We also find that monetary policy is a rather blunt policy instrument to deal with the pandemic, and find that monetary and fiscal policies are complements in that they reinforce each other's effects. Thank you for your attention, and I look forward to Camelia's discussion and your comments.
Thanks, Balint. So Camelia, your turn for the discussion. Thanks.
Excellent. Thank you so much. I'm sharing my screen, and let's make it full screen. All right. So unless there are complaints from the audience, I'm assuming everything's good. And once again, I'm very grateful for the opportunity to discuss this paper, which is aligned with some of my current research interests. So to give an overview, the paper is concerned with the effects of corporate QE announcements by the ECB and the Bank of England on firms' valuations. And the key dependent variables here are equity returns and CDS spreads. And the authors, Balint's presentation was extremely clear, and it ran through most of the paper's results. There are a lot of interesting heterogeneity at the firm and country level in terms of how firm valuations responded to these announcements. So this is an event study around the ECB's PEP and the BOE's LSAP extension on March 18-19, and the focus of these two programs was to purchase IG-rated bonds of Euro area firms or UK firms, respectively. So the main results of the paper highlight this heterogeneity across firms and across countries. For instance, abnormal equity returns are higher for firms with certain characteristics, for instance, firms in less COVID-sensitive industries, for IG-rated firms, and so on. And then generally, as we compare the results, the CDS spread results mirror the equity return results. But leverage is a little bit more significant, at least that's my reading in the CDS spread regressions. So the key takeaway is that, as presented in the paper, is that overhang likely explains some of the empirical regularities that show that high leverage firms appear to benefit relatively less from corporate QE, and that COVID-sensitive firms gained also relatively less from corporate QE. So, there's this idea that these public programs don't buffer enough the most exposed sectors. So my comments will focus on two broad areas. First, I'm going to talk about the paper's focus and positioning in the literature. And I see two narratives here. There's a bit of, there are many results, so I'm going to try to give some direction, possible direction for the two narratives. And secondly, I will make some suggestions on the empirical approach. Things that as I approach the paper, would like to see. In relation to the focus and position in the literature, I think there are two narratives that are occurring simultaneously in the paper, and I think at some point maybe a choice will have to be made as to highlight one over the other. So if the paper is truly about debt overhang, then I would like to see more on debt overhang. I would like maybe the focus of the paper to be squarely on firm leverage indicators and more direct tests and more comprehensive tests of this phenomenon. So as we know from Sebnem's work and preceding work, debt overhang is a situation where debt holds back investment. So the idea here is that firms have a hard time raising capital because it would benefit debt holders as opposed to new investors. So firms end up passing up profitable opportunities. They underinvest. So even when they have good projects, they just cannot borrow because they are so indebted. But in the context of QE, we may think that leveraged firms, which are more constrained, should benefit relatively more from the easing of constraints associated with the corporate QE, with the bond purchases by the central bank, because these bond purchases are special. There's no expectation of return from the central bank. So we can think of them as acting or serving to reduce firms' total debt. So one hypothesis would be, and I think Balint articulated it very nicely, that corporate QE may actually help debt overhang firms to start investing and growing more and become normal again. So that is a possible interpretation or a possible expectation, and one can take this hypothesis to the data. And so if the focus stays on this debt overhang story, I think the paper might move in the direction of adding to the financial outcomes regressions we've seen some real effects. So I wonder if it's possible maybe to bring together some microdata on bonds or loan issuances to take a closer look at the financing decisions of these firms during the COVID pandemic. What happened to firms' access to bond financing? I mean, borrowing costs in the bond market literally hit the floor, and not only for IG firms, but for very risky high-yield firms as well. What happens to credit line borrowings? We know that the first quarter, large firms around the world went ahead and borrowed, demanded liquidity to shore up their cash positions, insofar as they had access to such liquidity from their banks. And then later on, as the bond markets reopened again, they started paying back that debt. So do we see nice heterogeneity there across initially high levered versus not so high levered firms? Can we bring in some real effects data? Anything on what happened to the real outcomes of these firms during the pandemic? Investment plans, wage bills, employment? What about their survival rates? And if we just scan earnings calls, the samples of firms are not that great. One can even do this manually. If we just scan the earnings calls through the pandemic of levered firms, of debt overhang firms, what do we see them say about their investment plans? I mean, these are massive corporate QE programs, so I cannot imagine that firm CEOs don't make reference to the programs, depending on whether they are eligible for their outstanding bonds to be purchased by the ECB or the BOE. Now, an alternative is to say, well, I would like the paper to be more about uncovering heterogeneous announcement effects in general. And then in that case, maybe I would de-emphasize these overhang suggestions I just made, because that would make the paper just about overhang. And instead, I would focus on the direct and indirect effects of corporate QE announcements. And in particular, I think I would focus on the indirect effects because there's less literature, less knowledge, fewer findings about that. And I'm very intrigued, and I find very interesting results in the paper that show that corporate QE announcements benefited many firms that are in third countries. They are not eligible for their bonds to be purchased by the BOE or the ECB. So I would like to see that topic explored more. And I think that's where the paper has the most potential to innovate. It might not be necessarily the same paper. This could be pursued in parallel. So insofar as that is being pursued indeed, then one could say that the paper contributes to a little bit more broadly the literature on transmission of unconventional monetary policy programs that tend to backstop capital markets and tend to also have limited take-up. And in that regard, I would love to see a discussion about how much take-up there was in these programs at the end of the day. Probably not much. In the US, surely there wasn't that much take-up. So on the empirical approach, should we stay within this framework of analyzing the direct and indirect effects of corporate QE announcements / purchases? I wonder if there were any other announcements in the window that is being analyzed. I know that there were announcements in the US on the same day regarding possibly effective anti-malarial treatment. I think some of those announcements were later debunked by the medical profession, but still there was an impact in the US on stock markets. So a discussion about possible confounders, even within the tight, narrow window, would be useful because so many things were happening at such a rapid pace during the crisis. Now, very importantly, I would love to know, as a reader, as I approach the paper, I see that there are important announcement effects of these programs, but there were actual purchases too. I mean, at least the Fed, for the first time, was buying corporate bonds. So there was a lot of discussion, a lot of market intelligence out there about the possible effects. And so the question is, if we take the actual data for the BOE and the ECB, do we see additional boosting effects of actual purchases on firms' valuations and real outcomes? Is it possible, for instance, would it be possible that bonds with higher ex-ante probability of purchase, so those bonds of firms of higher quality, actually ended up being bought? Or the take-up of the programs were super limited? I don't know. What about differential effects for COVID-sensitive bonds versus others? So basically, I would like to suggest in general that the analysis move to a place where we can distinguish between bond and firm-specific factors. US studies find, for instance, that bonds with longer maturity, better credit risk, and larger issue size, not necessarily more sensitive to COVID, were purchased. So a comparative analysis with Europe would be very insightful, because it would tell us first something about the frictions that the government is trying to alleviate with these programs. And second, we would find out if these modern forms of UNP, which itself is very modern, largely operate through announcement effects, or if there are additional purchase effects. And then still on the empirical approach, I mentioned earlier there are these interesting results in the paper about spillovers to financing conditions or firm valuations for firms and bonds in the non-EU or Euro area, non-UK third countries. I copied here the paper that shows, for instance, that IG-rated firms from elsewhere, not headquarters in any of these countries, benefited from, in terms of valuations, from corporate QE. So it kind of looks as if the tide lifted all boats, and I would be interested to see a bit more work in that area. Who are these firms? There's a very interesting footnote mentioning that some are Russian firms. So I would like maybe to see like a country distribution and see whether those valuation gains, how are they quantitatively and are they sustained after the event study window? And why are they there? Is it because those firms are in trade linkages or financial linkages with the firms directly targeted by the program? Are there supply chain linkages? And then finally, if there are very meaningful such spillover effects to third countries, to foreign firms not eligible for any of these programs, what are some of the policy implications for the ECB and the BOE's corporate QE? So to wrap up, I think the paper, as I approached it, I found it very well written, very easy to follow and understand, and it has a lot of promising results. It asks whether corporate QE affected firm valuations in Europe. It focuses on announcement effects, but it documents a lot of heterogeneity in the results, as well as direct and indirect effects on local, eligible, non-eligible firms and foreign non-eligible firms. So lots of results. I think there are some intertwined narratives there. So my suggestions were simply to maybe think about maybe separating them a little bit and take the paper either in the direction of focusing more on the debt overhang angle or the indirect effects on non-eligible foreign firms, which I think is underexplored at this time in the literature. And so just let me congratulate the authors for the paper, and I look forward to seeing revisions. Thank you.
Thank you, Camelia. Let me remind the attendees of this session that you can put questions in the Q&A button. Otherwise, let me give the chance to all other panelists. Maybe if some of you want to pose a question on the paper or on Camelia's discussion. No? So let me give you, Balint, maybe the floor for just a couple of minutes, if you want to react to their discussion.
Yeah, thank you, Camelia, very much for your very nice discussion. Lots of extremely useful suggestions, which we'll obviously look into. I just want to react to your first point about financial versus real debt hangover. So the issue that we face there is that it's very difficult to disentangle what the market knew at the time of the announcement about firms' abilities to implement, to grow in the future, and separate that from the benefit that they would enjoy from lower refinancing costs. And so that's why maybe Yeah, so in the paper, we kind of put these two effects together. We try to concentrate on the refinancing, the lower refinancing costs, but these two things are there simultaneously. So we can definitely try to look at your suggestions to separate these two effects. Definitely looking at investments during the pandemic and wage bills and so forth could be a way to go. So thank you very much. One more comment. So why do we include those European countries that we did? We basically used Thomson-Reuters classification for what is a European country. But otherwise, thank you. Do I have a minute to respond to one more point? So other announcements. We went through newspaper articles in Europe, and we didn't really find anything else that seemed significant. As for the US, so to calculate excess returns, we use the MSCI World Index. So hopefully, that takes care of these global effects. But thank you very much for your comments.
Thank you.
Okay. Thank you, Camelia and Balint. Let's move to the last but not least paper of the session. So it's Nick Sander from Bank of Canada going to present. Again, Nick, you have 20 minutes. And then the discussion will be by Emanuele Tarantino. Nick?
Okay, let me share screen. Can everyone see that?
Yeah, we do.
Okay, great. Thank you so much for including us in the program. It's a pleasure to be here. This paper is co-authored with Pierre-Olivier Gourinchas, Sebnem Kalemli-Ozcan, and Veronika Penciakova, and the standard disclaimer applies. So we know that COVID-19 was unprecedented in its complexity and severity. The worry in 2020 was, and in 2021 still is, that the crisis may trigger many firm failures and is looking forward, particularly as policy starts to unwind. And in particular, we're thinking that the risk of the failures is largely concentrated on small and medium-sized enterprises who may lack access to credit required to smooth over the effects COVID-19 has on their cash flow. So in this paper, we investigate the impact of COVID on SME failures in a wide range of countries. We also look at the costs and effectiveness of a variety of government interventions aimed at saving firms. And I'm also going to show you today some results from our companion paper that's in the AEA's papers and proceedings, where we look at the effect of succeeding at saving firms in 2020 on likely firm failures in 2021 as policy is unwound. So time is scarce, so I'll just give you a very brief overview of our methodology and discuss that the key challenge of what we want to resolve with any liquidity-based failure criteria is what's going to happen to cash flow over the year of 2020 due to COVID. And this is a concept we can't really observe in real time. If we did know this, then we could assess a liquidity criteria for firms really easily. We could ask if a firm's beginning of period cash balance plus its cash flow over 2020 or under COVID, in other words, the sum of these two, the end of 2020 cash balance, we can ask if that end of 2020 cash balance is enough to cover a firm's financial expenses or the interest on its debt. Now, if a firm cannot meet this benchmark, which does assume it can roll over its existing short-term debt, then that firm has likely failed. To estimate cash flow under COVID, we then combine a structural model with data from Orbis, a large representative firm-level financial data set, which contains balance sheet and income statement data. Note that if we assume that the 2018, the most recent year we have available in Orbis, is representative of the distribution of firm-level balance sheet data in a typical year, then we can assess the effect of COVID on cash flow using head algebra. We can take the data from of the firm data of revenue and cost of goods sold in 2018, and we can perturbate that with two different shocks that reflect the effect of these, the effects happening to firms due to COVID-19. And so our structural model does exactly this. We input of a rich variety of COVID-related shocks, and each firm will cost minimize its labor and materials costs given their particular set of COVID-19 shocks, which we're going to calibrate at the 4-digit NACE sector level. So let me now describe these shocks to you. If we consider a firm I in sector S with employment NIS and productivity AS, there are 4 types of shocks we let hit firms. Firstly, we have a labor utilization constraint to reflect workplace restrictions. If we let a prime denote the value of a variable under COVID, then this expression reflects that workplace social distancing may require, let's say, restaurants to operate their kitchens at, say, 1/3 capacity. If this X hat S was 1/3, employment under COVID relative to non-COVID has to be less than 1/3, meaning that restaurants can only operate at 1/3 of their usual capacity. So note that this constraint reflects 2 things. It reflects both workplace restrictions imposed due to a lockdown, so essential sectors are likely exempted from this particular shock. It also represents how feasible it is for a sector to convert to remote work. Education, therefore, may not have a particularly tight constraint here because classes can be moved online, even though if we look at the letter of a lockdown restriction, education would be one of those sectors that would potentially be, targeted as non-essential in a lockdown. Okay, to calibrate this data, we follow the approach of Dingle and Neiman to use ONET data to assess the feasibility for remote work in sectors we classify as non-essential. Essential sectors are assumed to have no workplace distancing shock. This X hat S for them is infinity. Okay, the next shock is to reflect that remote work, while feasible, may not be as effective as working in a centralized physical location. In the absence of good data on this shock, we just assume that the productivity of remote workers falls by 20% across the board. And let me note that all of the numbers I'm going to present to you today are robust to selecting different numbers for this productivity shock. We get similar results. Finally, we have a demand shock to capture the effects that social distancing has on people's consumption. So that's this D prime over D term here. And without loss of generality, we split this shock into 2 terms. A sectoral redistributive shock, psi hat S, that's unchanged on average, but varies across sector. And then a second shock, PD hat, that captures the average movements in consumer expenditure across all sectors. Psi hat S captures the transition of consumption away from restaurants and towards socially distanced forms, such as online shopping. And to calibrate this shock, we return to ONET data, except now we classify sectors based on the degree to which they produce an output that requires face-to-face interaction. Sectors, again deemed as essential, are given the highest value of this demand shock. Finally, the aggregate demand shock PD hat captures both precautionary savings effects as well as any general equilibrium changes in income and spending. We calibrate this using quarterly GDP forecasts made by the IMF in their June 2020 WEO report. Okay, here are graphs of the 2 most important shocks, the workplace restrictions on the left and then sectoral demand on the right, showing variation at the 1-digit NACE sector level, but bearing in mind we're calibrating these shocks at the 4-digit level. So note that for our labor restrictions, these are most severe in service sectors and mining, whereas the demand shock is more severe in customer-oriented sectors. Note also that majority essential 1-digit sectors shown in orange tend to have the least restrictive demand shocks. Any paper has its limitations, and we discuss ours in detail in the paper, and I'll list them here. But in the interest of time, and I want to sort of show you our results, I'll leave the discussion of these to the Q&A section, and to the discussion. So turning now to our results, I want to start by focusing on a single 8-week lockdown scenario without any government intervention. So this is a sort of counterfactual simulation of COVID-19 in the events that governments didn't react. Now, for our high coverage set of countries where the Orbis data captures a large share of overall SME revenue, we predict that in a non-COVID 2020, bankruptcy rates would be about 9.6% of firms. And this is our estimate of a normal bankruptcy rate in a typical year. When we run our 8-week COVID scenario, this 8-week lockdown, the failure rate is almost double to 18.81% of firms, meaning the effect of COVID-19 on SME failures absent any government support is the difference between the two, 9.21 percentage points. Now, naturally, this masks a huge degree of heterogeneity. So you can see here, I'm showing the variance in these deltas, the third column here, across one-digit NACE sectors. And you can see here that this delta varies from 2% above a typical year in electricity to over 25% in entertainment and recreation. Okay, so the sectoral variation here is enormous. We also see considerable variation across countries, with failure rates ranging from 5.4% in the Czech Republic to over 12% in Italy. And interestingly, this is to do with two things. One is the sort of differences in sectoral specialization changes the sort of set of shocks each country is exposed to. But in the case of Italy in particular, their firms, for whatever reason, hold very little cash balances. And that left them very exposed to the COVID-19 shock, to the same COVID-19 shocks that might be affecting other countries. Okay, I'm running short of time, so I'll or at least where I want to be at this point. So let me go through this slide a little quickly. So we documented considerable risk to SMEs, but there's also the question of whether these SME failures could themselves impose stress on the banking system. And we do some calculations to show that at least on average, the banking system is able to withstand the effect of these SME failures on the changes in non-performing loans. When we calculate a change in the common equity tier 1 ratio among our country, amongst a limited set of the countries we can collect data for, we find this ratio would fall about 2.1 percentage points from a level of about 14.2 percentage points. So, not nothing, but something manageable by banks. By contrast, when the EBA did a stress test in 2018, they generated a 4 percentage point decline in the common equity tier 1 ratio. And so this is sort of about half the size of a typical stress test scenario. Okay. The key thing missing from the analysis I've shown you so far is government interventions, which we know were large and were very important. So there's a lot of policy variation in practice, and in the paper we have a lot of results about the effects of different policies, but today I'm going to focus on two dimensions of that, which is I'll compare an ideal benchmark policy to two more realistic policies implemented in practice. And if I have time, which I hope I will, I'll be able to talk about the implications of policy going forward into 2021. So to start with the simple benchmark policy, given our exercise, we've actually calculated the exact cash deficits of every failing firm. And so we could calculate the minimum needed to bail out those firms to keep them viable until the end of 2020. And so we do that for the firms that we call viable. These are these 9.21% of firms here that are only failing due to COVID. In a non-COVID 2020, they would be viable, but because of COVID, they have failed. So that's our benchmark policy, is the minimum amount of cash needed to bail out these firms. Then turning to two more realistic policies, a lot of policy support tended to take the form of covering firms' wage costs. And so we consider a cash grant or labor subsidy where during our 8-week lockdown, firms receive 100% of their wage bill in grants from the government. That's for the 8-week lockdown. We also consider a policy we call a pandemic loan, which is where SMEs are going to, in 2020, receive amounts given by this disbursement formula here, which roughly reflects guidance by the ECB and its loan guarantees program for basically how the formula under which loans were dispersed. We're also going to apply this during our 8-week lockdown. Okay. There is issues of repayments with this loan, and I'll discuss that later in the talk. From the purposes of 2020, however, we're going to assume no repayments or interest are made. And so both policies from the perspective of our framework are simply a transfer of resources to firms. And so the results, the basic results are here. So if governments knew the exactly which firms were failing due to COVID, they could bail out all of them, saving in the process almost 5% of jobs, and the cost of which is a mere 0.8% of GDP. So this policy may seem very low, but this is actually what we calculate as the cash deficits that firms are running. It's not negligible, but also not particularly large. However, when we turn to a more feasible policy, because the government, after all, doesn't know the exact cash deficits of firms, we see that while we can save a meaningful number of firms, 5.8% for the labor subsidy, or almost the 9.21% of firms that failed in the pandemic loan case, you can see here that while these policies are effective, they're also triple or 8 times the cost of our benchmark policy. Okay. So when we look at why this is, there are 2 possibilities coming from why it is that policies in practice tended to cost so much more than in our benchmark. One is that policy has ended up going largely to firms that were weak. They were going to fail in a non-COVID scenario anyway, and now they're getting a large amount of government support and soaking that up. Or it could be because a lot of support is going to firms that were strong and didn't actually need any support to survive COVID. And what we find is the bulk of the policy costs in both cases, 1.94 of that 2.38, or 4.71 of the 5.81 numbers is going to these strong firms, which suggests for countries with limited fiscal space, they can make their policies more cost effective by focusing on clawback policies targeting these strong firms. One such policy we discuss in the paper would be a future excess profit tax to claw back some of the money going to strong firms while retaining the support going to viable firms that is needed. Okay, so now I want to talk about a little more of the results in our companion paper, looking a bit more forward into 2021. So firstly, we know in many countries that COVID-19 was worse than our 8-week lockdown scenario. Some countries had 2 or even 3 and are potentially considering 4 lockdowns, and policy support was likely more generous than we considered above. So we're going to introduce an additional 6-week lockdown, and we'll focus our analysis on the most generous policy, the pandemic loan, which will now extend for an additional 6 weeks to cover both lockdowns, the original 8-week and the following 6-week. Now, when we run the numbers for 2020, we get the following. The same 9.6% of firms fail in a non-COVID 2020. Now 19.5% of firms fail due to COVID, but policy is saving 9.57% of, the failure rate falls when we add policy back down to 9.57%, similar to a non-COVID 2020. So we have a large shock really hitting firms, creating pressure for high bankruptcies, but at the same time, very generous policy protecting them, at least in 2020, from failure. So the next question I want to look at is what's going to happen in 2021 once the policy support is unwound? And so, you can think of some sub-questions here. Was policy merely delaying failures? Is there a ticking time bomb of firm failures coming down the line once policy starts winding down? Secondly, repayment of policy loans. Does that matter for SME viability? And then a third question we might wonder is how does financial market functioning reflect these, sort of interact with these, the policy unwinding? So to look at this, I'm going to consider 2 scenarios. One is where we require the pandemic loan to be repaid. We treat it as a 5-year loan with 0% interest, meaning that in 2021, 20% of that policy loan needs to be repaid. Then we consider a second scenario, which is where financial markets freeze, and in particular, they've refused to roll over any of SME's pre-COVID short-term debt that was due for repayment within the next year. Normally it's rolling over, but in this scenario, we won't let the SMEs roll over that debt. And so the results are in the table here. So firstly, in a scenario where SMEs can roll over their existing short-term debt as normal, but they have to repay the policy debt, we find an excess failure rate, that delta is only about 1.88% of firms. So, a fairly modest number, which suggests to us that there's not really that much risk of a time bomb in 2021, even requiring policy loans be repaid, with the caveat that nothing else goes wrong. If we consider our case where financial markets freeze, now we're starting to see failure rate numbers that are looking like a time bomb. 8.5% of firms, that's similar to the effects of the COVID shock I showed you earlier, could be failing in this scenario. However, when we look into what this is, this actually seems to be unrelated to the actual COVID shock. We divide our firms into two groups: those from the perspective of 2020 that didn't need policy at all, they would survive 2020 without policy, and those that did need policy to survive 2020. Now, if this was interacting with COVID, we'd expect the bulk of the rise in firm failures from this 2% to 8% to come from the saved firms. And while there is a rise here, the bulk of the rise is coming from firms that, from the perspective of 2020, looked strong. And so this financial market freeze issue is an independent additional shock that might be occurring. It's risky because it can become self-fulfilling. When we calculate non-performing loans, banks, by refusing to roll over SME debt, could face very high NPLs, justifying their decision not to roll over SME debt. So there is a risk of a self-fulfilling prophecy. I think I'm at time, so I apologize. I think I'm running over. Just quickly to conclude, we show COVID-19 likely did pose a significant risk for SMEs. Failure rates without government intervention could have been 9.2% higher. The fiscal cost could have been low of bailing out these firms, in theory, if we had the right information. In practice, policies are less efficient, but we can get much closer to our benchmark policy by focusing on clawback of funds distributed to strong firms. In 2021, or the remainder of 2021, the sort of key risk to manage going forward is thinking about financial market panic. Okay, thank you so much. Apologies for going over time.
Thank you very much, Nicolas. So let's move to the discussion by Emanuele.
Let me share the screen. Can I start? Okay, so, first of all, let me thank you for giving me the chance to read this paper. I've been thinking recently about bankruptcies in COVID, so this was really illuminating on many aspects of the problem. So what is the goal? You probably have, Nick's presentation was super clear, but let me just recap. There are many things in the paper, so it's good probably to. The goal is to develop a tractable framework that allows us to quantify the costs and benefits of government policy interventions during COVID. So there are three parts. In the first, they solve a partial equilibrium model of supply and demand. Then they bring the model to the data using absent any policy intervention. So what will happen absent governments putting money to fix the crisis? And then they simulate a number of scenarios, actually quite some. And Nick presented additional few more actually that I hadn't read. Some are very interesting too. And these scenarios are taken, are borrowed from what happened in reality. The data they use is Orbis firm level data, and most of the results, the bulk of the results come from 13 high coverage countries for whom they have more data. Okay, so how does COVID enter the model? So the model is rich, very rich. It enters at the level of the productivity shock. So the production function has a productivity shock that is affected by COVID. It enters at the level of the labor supply decision. So there is a labor supply constraint, and there is a parameter X that captures this effect, whose value depends on the industry, depending on whether it's easier or not to get people to work and find people to work, or to move people online. Consumer utility maximization is affected by aggregate demand and sector-specific shocks, Z and PD. Firms are forced to meet demand. So now let me enter the two main restrictions under which the model is solved. So firms are forced to meet demand. So whenever there is some demand, they have to cover it. They cannot just decide to stop, even though there is an extension addressing this. And another one is that they cannot adjust prices. So this is a model in which pricing is not, so prices is kept sticky. What is the key, in my mind, the model deliverable is a default condition. So at the end of the model, they derive a default condition, and this default condition is what they play with. Well, one of the ingredients, probably the main, with when they play in the scenarios. Now, what is the default condition in the model? In the model, default condition, so default happens if operating cash flow under COVID-19, so post the shock, are lower than the interest payment net of the cash holdings. And this embeds all of the decisions and ingredients and moving parts that you have, that we've been describing so far. So in essence, in this model, bankruptcy is, or insolvency is illiquidity. So if you fall short of liquidity, you go bankrupt. And this can happen over a time horizon they kind of, play with. It can be 1 week in the extreme scenario, to a 1 year in the other extreme scenario, to accommodate for more flexibility in the decision to go bankrupt. There are a number of policies that are considered. The benchmark one is the one that requires a lot of granular information on the side of the government, and of course is the more precise one. It is a bailout policy that only says the firms that go bankrupt fail precisely because of because of COVID, excluding those that would have failed anyway. So this is the ideal policy, but it's difficult to implement in practice. So in exchange, what they do, they look at waivers of a number of waivers. So on firm financial expenses, or interest payments, taxes, or rent. They also look at cash grant index to firm wage bill, and the public loan guarantee. So it's difficult to set which policy is best. Depends really on sector. There could be sector specific, government, country specific. But what is nice is that the benefit and the cost are really well and clearly explained throughout the paper. So I think it's super timely, of course. What I really liked is what, as I said at the beginning, is that it provides a conceptual framework that helped me think about all the channels through which COVID affect the economy, and this is super nice. It's also useful to sign the cost and benefits, the trade-offs behind each government policy. And all in all, I've been really impressed by the amount of work that's been put in the paper. So it's, despite being long and very rich, it comes across very consistently and clearly, which is not easy. So what happens? So absent government policy, the model predicts high default, high default rates. And this is one of the tables, probably the first one with some model results. What is nice is that the model allows us also to disentangle the contribution of each shock across sectors to the default rates. And that's also very neat. And the effects of each policy considered. So these are the policies considered. This is the margins through which we assess the good accounting of the policies. Now, in reality, what happens is that defaults were lower than in previous years, And this happened especially during the breakdown. This is data from Italy, and you see that for some reason, and of course, some of the reasons are explained in the paper, the default rates went down with respect to 2019. Then to pick up, so to close the gap later during quarter 3 and definitely quarter 4, but still remaining lower. Now, this has raised concern. So here I'm just reporting a Twitter by Gopinath. But and you see that what happens, what seems to happen is that especially early in the crisis, there has been a fall in default rates. So why is it so? So this is surely happened because governments adopted a bundles of policies to limit the damages. Now, my first question now is for you guys is, do you think it? So I mean, asking you to do more to me, I mean, it looks like you've already done a lot, but I was wondering myself if you can discuss the possibility that instead of considering one policy in isolation, you consider a combination of policies. And I'm asking because I'm not, into the model as much as you guys, but I wonder whether there are synergies across policies that make them complementary and in a way, allow you to exploit, exploiting these synergies would reduce the cost and improve the benefits. This I don't know. It's probably something that just cannot happen for a technological reason. But I was wondering whether you can, you can at least think about that. The second thing is another reason why it didn't happen. So the increase in default rates didn't happen is that in some countries, in your report. This is a study from the OECD, firms could just not default. So there was no way to go bankrupt. There was a moratorium on bankruptcy. So no way you could go to bankruptcy court and you can be brought to bankruptcy court by your creditor. Now that's another policy that probably we can discuss. So, and in a way, I've been thinking about, so some of your policies touch this aspect of government intervention, but to me, they don't seem quite the same. So I was wondering whether you can discuss whether imposing a limit to go bankrupt, you just cannot go bankrupt despite being short of liquidity, affects anything in your quantification, together with other policies that you consider. Now, what else can be done starting from what you've been doing? So you mentioned this time bomb analysis that I haven't seen in the paper, but I think more. So far, as I said, there is a pretty, let's say, there is quite a precise, specific definition of bankruptcy. Bankruptcy and insolvency is equal to illiquidity. So, but we know, and the authors, acknowledge this in this paper, that bankruptcy is more than that. So I think more work is needed, and probably this is what you've been doing already, to understand the role of bankruptcy design in economies with large default rates. Here I'm citing a post by the ESRB thinking exactly about this. So how governments should address the possibility of high bankruptcy rates in the future. And for that, you need probably more structure on the bankruptcy condition. But of course, the paper provides a framework to start thinking about this. Another direction could be taken, given the infrastructure already developed, even though this requires probably more work, is considering input-output linkages. So how COVID crisis affects not just within country, but also across countries, supply chains and trade. But again, it's a model you can start with thinking about this issue. Then I have a couple of more specific questions, but probably just very fast. So one is whether for some of the variables you use in the model, in the empirical part coming from the model, are consistent with data. For instance, prices are assumed to be sticky, but price index may vary due to demand shocks. And maybe, just to understand to what extent this assumption is a limitation, you could plot the price index from data and from the index that is predicted by the model to understand, what is the direction of the bias, if there is any. Also, and this is really minor, super minor. So it seems from footnote 37 that you use all this data to determine COVID-19 risk for banking sector. So it's as if you take defaults based on all this data, if I remember correctly, if I understand correctly. While I thought that you wanted to construct these default rates based on what the model would predict would happen. But that can just be probably that I misunderstood something. And yes, so that's all. I really enjoyed reading the paper. It was very, very nice and really informed me about what can happen, what has happened, and how to think about the shock in a broader framework.
Thank you, Manuele. Is there any other question from the panelists or from the attendees through the Q&A? Not for the time being. So maybe we can use, we have 4 minutes left for this session. So maybe Nick or Sebnem, if you wanted to reply to Emanuele or start replying, and then you continue on a bilateral basis.
Sure. No, thank you so much for that. That kind and great discussion. I think you're raising questions that we're also wanting to think about. I can summarize, briefly, like thinking about bundles of policies. The sort of rough finding is that we've looked at sort of do multiple policies get in the cracks of what other policies miss? And I think the broad sort of result is, the more generous policies are, and even as you bundle, you're saving additional firms on the margin, but you're not sort of getting the same bang for your buck. So, there's huge skewness and cash deficits. There's some firms that are very, very, very hard to save, and getting to those firms, it can end up being very costly with a poorly targeted policy. In terms of the moratorium on bankruptcy effects, I'm not sure how we'd integrate it into our model, but it does limit benchmarking our model relative to data. It's not clear in the, because of these moratoriums, what we see in data is if it's actually representative of hugely effective policy, preventing firms from needing to declare bankruptcy, or simply firms are bankrupt and can't file. And so we, teasing that out is quite difficult. But I will say that when we do bundled policies, we do get failure rates below non.
Right, that's another question I wanted to ask. Indeed, yeah. Okay. I think these were all great points. And on your final clarification point, I think we possibly need to reword the footnote. We take the loans from Orbis for the firms that failed in our model-based scenario, and that's how we construct. Okay. So you take the first. Okay.
Yeah. So
okay, now I understand.
Yeah. Apologies
now
for
I
not
understand.
on that. I think we'll
it just it can just be that I miss some. I mean, that's not a big deal. But no, sure. I mean, the thing of the moratorium, I'm not sure how much it matters, but in Italy there was a lot, huge discussion about it, and the fact that firms kind of go bankrupt. So this is why I thought it could be interesting. But I see I see the challenges.
Let me interrupt you. There's a question from Carlos from the attendees. I'm not sure he can speak up or put the question in the chat. Carlos? No? Well, okay. We had a request for the question, but I don't know how, unless he puts the question in the chat or takes the phone, or the microphone. Yeah, so sorry. Go ahead, Nicolas, if you wanted to react some more, or.
No, I just, I think the comments, so these were great comments, and thank you so much.
So I see now Carlos with the hand raised. Go ahead, please.
Hello?
Yeah, we hear you, Carlos. Go ahead.
Oh, great. Hi, just quick question. I wanted to ask Balint about how you compute the fiscal cost of what you call pandemic loans. The reason I'm asking is that in practice, I guess you mean like the guaranteed loans, right? The loans that were guaranteed by the government. These programs did not have a fiscal cost itself, right? It was lending by banks. Of course, the fiscal cost will come later when you have defaults and the banks call upon the guarantees, but the actual fiscal cost is yet to be seen. But in any case, the figures I saw on the tables look very large. Like 5-6% of GDP. That seems very large to me. The actual envelope of these programs in, say, the large Euro area countries were about 8 to 10% of GDP, but the envelope, meaning the size of the total loans to be guaranteed by the government, but the actual fiscal loss, which will depend on the amount of defaults, should be much smaller than that, right? So again, how do you exactly calculate the fiscal cost of the pandemic loans?
I think this is a great question, and it points out it's a subtlety. We changed the label in the paper specifically because of this. Is we're calculating funds disbursed because of the policy. We're interested in getting at what are the funds going to firms, and so the label cost is, as I agree, misleading. You should think of that as funds dispersed, and we're not really able to calculate the exact fiscal cost because we don't know what repayment rates on the loans are going to be. We discuss in the paper, how low it could be if, our strong firms and viable firms repay the loans. You can get a cost from the pandemic loan policy that is a little larger than the ideal policy with, that depends also, on repayment assumptions and so on. So you should think of this as sort of, this policy mobilized about 6% of GDP in additional lending. But, the cost is something in our framework we can't really, to government, the cost to governments isn't something yet we can calculate.
Okay.
All right, thanks.
I'm afraid we have to close here. So on behalf of Banco of Spain and the organizers of this session, I thank you all. It's been great presentations, great discussions. I think a lot of food for thought for future papers or future versions of the current papers. And thanks again. So we will finish here this session. Thanks a lot.